Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers, where I challenge you to replace a 10th of an hour of billing with a 10th of an hour of learning. For today's episode, episode 17, we're going to gear this towards a specific audience of financial advisors and wealth advisors, with the caveat that you need to be careful in handling your clients' IRA rollovers and beware of late rollovers. And I'm going to illustrate why in a minute, but for the time being, I want to preface that I don't do much in this space. I don't deal with advisor liability, but I bring this to your attention more from the perspective of, as an attorney, I get used to, where can things go wrong and where do you need to cover yourself. And this is not necessarily a warning, but just an illustration of, where things could go wrong and what some of the pitfalls are in handling IRA rollover funds for your clients. So back in episode 10, we talked about how there can be relief for late IRA rollovers in situations where the facts and circumstances show that enforcing the 60-day rollover window would be against equity and good conscience. And then if the taxpayer can establish facts that show that, then the IRS may waive the 60-day requirement if there is a late IRA rollover. Now that seems all fine and dandy, but the problem is that it costs money to get this type of relief. Typically you have to have somebody like an attorney or a CPA or enrolled agent who can assist with preparing the ruling request to be submitted to the IRS, and along with that ruling request there's a user fee that has to be paid to the IRS as well, and that user fee can vary based on your income and other things, but yeah, there's a lot that goes into making this request, thousands and thousands of dollars. And the big thing is that when you're making this request, what's going to happen is that somebody gets thrown under the bus. Oftentimes, it's going to be a financial advisor, because the taxpayer has to show, hey, I didn't do anything wrong. I put the handling of these rollover funds into the care of somebody else, and they goofed. And this was illustrated in a couple private letter rulings that came down the pike this past Friday. They were consecutively numbered but had almost identical facts, which kind of lent itself to wondering if the financial advisor and financial institution in question had been the same one. But that aside, in both of these recent private letter rulings, there were waivers of the 60-day rollover requirement granted. Now, it was to two different taxpayers, but under very similar facts, where there was a rollover distribution that was received by the taxpayer and or the taxpayer's spouse. And the intent was that that rollover was going to be deposited into more of a directed IRA that was going to invest in real estate partnerships. And in so doing, the taxpayers relied on the advice, quote unquote, of their financial advisor in making the rollover. But ultimately what happened is that the rollover distribution went into a non-IRA account, and then the taxpayers were surprised to get a 1099-R the following year. And when this happens, each taxpayer here alleges that the rollover was misdirected because of errors on the part of one, their financial advisor, and two, on the part of the financial institution administering the IRA. Now, everything turned out fine. The taxpayer was relieved of their excess tax liability, but it costs money to get there. And the ultimate question is, who paid? And which cost more, eating the tax liability or paying the fees necessary to get the relief requested? And it may not be an apples and oranges comparison. I just bring this up to say advisors beware, because the cost of these relief requests likely turned into E&O claims submitted to the insurer, who insures the financial advisor or advisors in question who supposedly, quote unquote, made errors here. So there's a lot to take in here that, it seems intuitive, and it might be something you already do and follow the compliance procedures for, but you just need to be doubly aware that you're tracking the chain of custody of IRA funds, especially if a check or something comes into your possession from a client which is intended to be rolled over into a new IRA or qualified retirement plan. So you have to track where the funds go, and in so doing you need to be comfortable working with the institution administering the IRA to which the rollover is directed, especially if you have somebody here like a financial institution who's not doing more of a traditional investment portfolio for the IRA, but an IRA which is more directed might have alternative investments like real estate partnerships, as was the case in the two rulings that we looked at. And as we've reminded you in a couple episodes here now, there is relief available under Rev Proc 2003-16 in general, and for RMDs that you've taken up to this point in 2020, as long as they're rolled over by August 31 of this year, you can have those waived RMDs treated as a valid rollover under Notice 2020-15, but if you're late in seeking relief, it can be costly. So, just because there is relief doesn't mean that you're not going to be thrown under the bus if your client decides to pursue it. So that's my soapbox for the day. Just be careful as to how you handle IRA rollovers, and don't rely on the fact that there is a backup relief available just because that backup relief means that you, as an advisor, could potentially get thrown under the bus. Thanks again, everybody, for joining me for this episode of The 10th of an Hour. As always, if you have questions and topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thanks again for listening, and I look forward to seeing you in the next episode.